Good morning and welcome to Renewi's first half year presentation. I'm excited to be here today together with Toby and we'll take you through the presentation. First, I'll start with an update on our overall results, giving you some highlights, after which Toby will go through the details, financial performance, both total company as well as divisions. And then I'll come back to talk to you about our strategy and the execution of that strategy as we move forward. So with the agenda today, we move from the agenda on to the first part. You can ask questions at the end of the presentation as we normally do. Let's first start with the first half performance. As you can see, a strong performance in rapidly evolving markets. Let's take a look at some of the highlights. In the first 6 months of financial year 22, we saw strong performance across the board. First of all, our revenue increased 11%, driven by strong volume recovery from last year, specifically in Belgium, where we saw the corona impact heavier than in the Netherlands, and that combined with increased recycled pricing. The underlying EBIT more than doubled versus last year, and commercial waste, representing over 80% of our business, showed record performance, delivering almost 10% of margin, which is double from what we had before. Also great to notice is that our leverage ratio stayed well below 2, achieving the board's target 2 years ahead of expectations. And this all despite the capex that we have spent and the increases that we have made commitments to fuel our circular innovations, where we committed 110 million euros on growth capex over the next years. Now, based on this strong performance, we further increased our full year outlook as well. And the strong financial performance goes hand in hand with a continued improvement on our sustainability performance. Our recycling rate has increased by a bit more than 1% to 66.5%. And by making secondary materials from waste, we help our recycled customers to reduce their carbon footprint by over 3 million tons of CO2 every year. Last year, we set out a target to increase our recycling rate from 65 to 75%, which we called our Mission 75. This will enable us to recycle an additional 1 million tons of waste. It will also ensure that we will reduce emissions for our customers by about 500,000 tons of CO2 that are avoided, because recyclates have a lower CO2 footprint than primary materials. And it will also strengthen our position as an ESG leader, where we already received top ratings by several world-recognized agencies. Now, Mission 75 is fully aligned with our strategy and also with 6 out of the 17 UN ESG goals. And these ESG goals become more important as the climate crisis is now an emergency. Over the last year, communities around the world have been confronted with more natural disasters caused by climate change. And in the IPCC report, these disasters are now directly linked to carbon emissions, and more scientific evidence is provided to confirm this. The world is not on track to meet the carbon reduction goals that were set in the Paris Agreement. And at COP26, that is happening this week, it has become clear that our world leaders realize that climate change is impacting our daily lives now and will even more so do that in the future. Now, most are stepping up to reduce the impact, and they start realizing that material reuse and recycling is essential to reduce carbon emissions. Now, ESG has been gaining momentum for years and has now become at the forefront for investors and companies who realize the strategic risks and opportunities that the environment can bring. Society is becoming more demanding, and companies see strong social demand to improve their sustainability performance, especially from younger employees and also their customers. And in response to all this, the European Union is pushing to increase recycling and the use of secondary materials. We saw the Circular Economy Action Plan, which pushes for defined usage of secondary materials. And in July, the EU published their Fit for 55 plans with a recommendation to put energy from waste plants under the emission trading scheme and apply a CO2 tax moving forward. We also saw that Flanders and Brussels, they announced recently that they will double their incineration tax per January, and also announced legislation to increase recycling and stop residual waste going to incineration without sorting. which is called this Flarema 55. But recycling more and increasing the quality of recyclate will require innovation and cooperation between different players in the value chain. Talking about the value chain, 2 weeks ago we showed in our virtual Capital Markets Day more about innovation and about cooperation with partners. And I can say that we have made significant progress in the development of our innovations over the last 6 months. In that Capital Markets Day, we showed in 1.5 hours in detail how we are progressing with our key programs, going from ideas to reality. And with these new investments, we will recycle an additional 1 million tons of waste and create lower CO2 emissions. Now, in the second part of my presentation, I will briefly talk about the key programs in our pipeline, which collectively will add a minimum of 20 million of additional EBIT. It's one of our 3 pillars of our strategy. But due to time, I will not cover some other programs like mattress recycling that we do in our joint venture with IKEA, where we continue to add capacity by recycling more mattresses. I also won't talk about the orange peel recycling we do with our partner Peel Pioneers, or the contaminated steel recycling that we started with our partner PMC. But all these programs are also progressing well. Now, innovation is something we often do together with partners, creating new value propositions in different market segments. And I strongly believe that these partnerships are required to build a more circular and sustainable economy. I now pass it over to Toby to provide more detail on our financial performance in the first half. So Toby?
Thank you, Otto, and good morning, everybody. Thank you for joining the call. So we will start with the income statement. Once the clicker works. So in the first half, we have had a strong performance in the first half. Revenues are up by 11%, 915 million euros. The underlying EBITDA is up 43%. The underlying EBIT is more than doubled to 63.8 million. The margin has increased to 7%, and that's flowed through, of course, the earnings per share up to 47 cents per share, up 213%. Now, that also comes through to our underlying returns. The return on operating assets has increased to a highly accretive 36%, and our return on capital employed is 9.5%, obviously taking into account goodwill, and it's a post-tax measure, and that's, again, accretive against our WACC of somewhere between 6 and 7%. Non-trading and exceptional items were further reduced again to 5.7 million euros with no unplanned or unexpected items, and that led to a statutory profit after tax of 37.1 million euros with no interim dividend declared. Now let's look at the core drivers of that. Well, as Otto said, high recyclate prices have been a key part of our strong financial performance. Recyclate prices close to all-time high, and of that, 65% is coming from paper and ferrous metal. More on that in a moment. But it's not just about recyclates. It's about the recovery of our business. It's about the volume and the mix. Recovery in the core volumes, particularly in Belgium, delivering an extra 9 million euros of earnings. Also important to see in an environment where people are more concerned about inflation, that our price increases have continued to slightly more than offset the cost inflation we experience. We see a contribution coming through from ATM, up by 1.9 million euros with higher throughput compared to the prior year. And some negative others, including in particular the reinstatement of LTIP costs in a post-COVID period. So let's look at those recycled prices in more detail. On the top chart, you've got the paper. On the bottom, you've got the ferrous metal. As I said, these recycled prices are close to all-time highs, really a 12-month increase that you can see clearly in the chart. Now, some of that, we believe, is structural. There are structural reasons why some of these recycled prices will stay above the purple line, will stay above historic norms. If you take paper and cardboard, for example, there is an increase in demand for cardboard in Europe. If you look at secondary plastics, there's increasing demand to reuse plastics within new plastics. On the other hand, ferrous metal prices have been expected to soften, and they've just started to come off around August, September, as you can see in the chart. What we use for our long-term forecasts is a reversion towards that long-term average. So let's look at it by division. Commercial Waste Netherlands So revenues were up 11%, underlying EBIT slightly more than doubled, 43 million euros, a strong increase in underlying EBIT margin to 9.8%, and again, a big jump in return on operating assets. Now, looking at the volumes driving that, actually the core volumes were broadly flat on the COVID period, and they're still 3% below the pre-COVID period. Now, what we've seen is movements as expected. So some of the unusual highs, like construction, demolition waste and bulky waste, have eased off this year. And on the other hand, we've seen a recovery in commercial waste, in particular hospitality. Overall, we're still seeing net customer gains. Recyclate prices, of course, drove a lot of the margin increase. But here again, we should be looking at this is a reward, if you like, for the very hard work we put in during the bear market for recycling, focusing on our pricing, focusing on efficiency, and that then reads through when the recyclate prices rise as they have in this first half. We've also delivered some structural cost benefits. A number of the variable and discretionary costs that we took out during the COVID period have remained below pre-COVID levels, even as the volumes have come back. And of course, we closed 4 sites last year, and we're seeing the benefits of that coming through. Commercial Waste Netherlands, as Commercial Waste Belgium, has new management, and we're shaping overall a more agile business and really focusing our capabilities on increasing our innovation, increasing our digitization. If we look at Belgium, you see revenues here up 15%, earnings up 159%, and again, a strong increase in margin and returns on operating assets. Here we have seen the volumes increase. Core volumes up 13%, recyclates up by 8% against the COVID period because, of course, Belgium had a more severe COVID, in particular the first COVID quarter compared to the Netherlands. But nevertheless, the volume still remains 7% below the COVID period. The margin increase here is primarily volume driven because of this volume recovery, but recyclates also contributed, and we're seeing the benefits of accretive capital investment. That drives quality and it drives our margins. Examples being the plastics line in Ghent, which you may have seen in Capital Markets Day. That's commissioned and operating well. We're also upgrading our anaerobic digestion facility in Roeselare. Otto will talk in a few minutes about advanced sorting. So let's turn to the Minerals and Water division. So here we saw revenues up 4%, underlying EBIT up 74% to 4 million euros, and then again an improvement in the underlying EBIT margin, a slight drop in operating assets for reasons explained in the footnote. If you look at ATM, the overall improved performance against last year, we're seeing good commercial progress with the new filler and sand applications, and critically, gravel is now certified as end of waste. The soil throughput, we increased to 55% from 35% last year with no loss of quality, and we placed around a third of the legacy thermally clean soil or TGG inventories in the market. The weak area for ATM, as we said in our pre-close statement, is that inbound flows of contaminated soil volumes remain weak. If we look at the minerals business, the Bren landfill closed in December last year as expected, but recyclate gains have offset the impact of those lost volumes. If we turn to our specialities business, revenues up 12%, underlying EBIT has now increased to 1.7 million euros. If we look at the 3 segments, municipal continues to deliver an encouraging underlying performance driven by ongoing operational improvements, but also stronger recyclate prices, and that offset the negative impact of high ongoing residual waste volumes. If we look at Coolrec's performing very well. We restructured it around 2 years ago, and those benefits of the restructuring and the operational transformation continue to feed through. We're seeing volume recovery in fridges and high recyclate prices. And as a result, that EBIT margin in Coolrec has gone from nearly break even a couple of years ago now to well over 10%. Malta, our glass business, has returned to profit this year with post-COVID volumes back up 13% on the prior year, still a little bit lower than 2019. So, turning to cash flow, the adjusted free cash flow was ahead of expectations, driven by those stronger earnings. After the earnings, you saw a working capital outflow of 36 million euros. Now, that's primarily driven by temporary delays in billing due to a process change in one of our Commercial Waste Netherlands units, and also by a structural reduction in payables. But most importantly, the days sales outstanding remain unimpacted by COVID-19. Replacement CapEx continues to be lower than expected. Interest costs lower because the borrowings are lower. And we note, of course, when you're comparing to prior year included a €55 million benefit from deferral of sales and payroll taxes. Which brings us to the overall shape of the leverage. The chart on the left shows you the leverage since Renewi was formed nearly 5 years ago. And you can see that the debt and the leverage are now at post-merger lows. Core net debt of €336 million, down over €200 million from its peak. Leverage ratio of 1.8, down from a peak of 3.1, and now down below the board's target of 2 times earlier than expected. If you look on the right, you can see the debt facilities. We issued a new €125 million Belgian retail bond at a 3% coupon. And we have liquidity of nearly €500 million, noting that we will be repaying one Belgian bond next year. Which brings us to the profit guidance for the year. We have increased our expectations in the second half. That's on expectations that the volumes will remain flat on last year. We're also expecting that recyclates will moderate down from the current highs towards that long-term average rate. And you saw that metals have already started, paper not yet, but there are indications that it will start to moderate in the coming quarter. Net price, we're expecting that our price increases we put through in January will materially cover the inflation we may see. If you look at other line items, the underlying working capital for the second half will be broadly flat. We expect a full year offtake cost for the thermal soil to be around €10 million. We will be repaying €10 million of Dutch deferred taxes in the second half, and the total cash outflow for the full year of UK Municipal will be €14 million, in line with previous expectations. Full year replacement CapEx will be a bit lower than previously guided at €80 million, with an unchanged view as the IFRS 16 leases. Growth capital will increase slightly, which is good news as we commit to the items that we laid out in our Capital Markets Day. That will increase up to around €23 million for the full year. Renewi 2 and the underlying tax rate unchanged. So with that, and to talk about our future and our strategy, back to you, Otto.
Thank you, Toby. Yes, when you look at our markets that we operate in, they are constantly changing. And in fact, we see an acceleration of change as we look forward. Demand of secondary materials will increase as consumer product manufacturers, like for instance IKEA and Unilever, are committing to reduce their CO2 footprint by reusing more materials. Also, the chemical and petrochemical industry are re-looking at their carbon footprint and are eager to replace fossil carbon with biocarbon sources where we can help. This page illustrates the tremendous upside opportunity for secondary materials. As you can see in the bar chart, in Europe, only a small to medium percentage of raw materials to manufacture products is supplied from recyclates. It varies in wood from only 4% to glass, where 73% of raw materials used in glass factories is supplied from recyclates. So in all cases, there is significant upward potential to replace primary with secondary materials. I've also listed on the left-hand side some of the key drivers that will increase the demand for secondary materials. First, I talked about the impact of regulation with targets both at European level and individual member states level. Second, consumer producers and the chemical industry want to reduce their carbon footprint. And third, there are advancements in technology that enable more and higher quality recycling and allowing recyclates to really used as a drop-in for virgin materials in production. So demand for secondary materials will continue to increase as time progresses. And to meet this demand, technology providers look at the waste sector to bring new and advanced processing technology to the market. And I think this emphasizes the importance that innovation plays in our industry and in Renewi at particular. Now, the strategy we laid out at the beginning of fiscal year 21 addresses this higher demand for high quality recyclates. It's built on the 3 pillars we often talk about. We aim to be the leader in recycling by recycling more waste and by diverting from incineration or landfill. We aim to be the leader in the production of high quality recyclates, so our secondary materials can replace primary. And third, we aim to selectively gain our market share within and also outside of the Benelux. Now, we also highlighted that for the medium term, we identified 3 major value drivers, each delivering 20 million of EBIT to boost our profitability and to reposition Renewi from a low margin, cyclical business to a higher margin growth business. And these are the ATM recovery, Renewi 2.0, and driving circular innovations. Taking the long-term transition to a circular economy in mind, we will continue to drive innovation to add more value to waste in the many years to come. Now, our current innovation pipeline is focused on 4 key programs. In this table, you can see our innovation pipeline per program and what we're investing when and what EBIT return we will see. In total, we plan to invest in those 4 programs at least 110 million euros over the next years in growth capex and in innovation, and this will generate a total return of about 20 million euros as a minimum. You can see that advanced sorting is the biggest investment with 60 million euros, which is followed by continued investment in our organics business and also in our ATM business for building materials. Each program will meet at least a minimum threshold of 16% IRR. We also have new programs in the pipeline that we are developing, and we will continue this overview and this pipeline with new programs as we progress moving forward. But now let me give you more insight in the biggest program, advanced sorting with Vlarema 8. With Vlarema 8, the Belgian government demands that commercial residual waste will be sorted and recyclates will be taken out before it goes to incineration. And Flanders, in that sense, is the first country or province that has announced this from all over Europe. They've been very specific on what is required and what will be allowed to still be in the residual waste when it goes to the incinerator as of January 2023. In the table on the right bottom, you see what is maximum allowed per 10 cubic meter of waste. And basically, it is very little, and it's a lot less than what is in residual waste today. This means that residual waste needs to be sorted in more advanced and innovative ways than how it's done today, using a combination of state-of-the-art technologies in sequence to meet these requirements. I think of infrared sensors, laser sensors, video imaging using artificial intelligence, next to the more traditional mechanical separation techniques that we already deploy today. The waste-producing customers will be responsible for ensuring their waste meets these requirements, but they can't do it themselves. So that's where, of course, our responsibility or companies like us will come in place. Now, the incinerators, in turn, will verify at their gate if the waste streams that are supplied meet the required composition. And if not, they will refuse the waste and they will apply penalties. Now, in Flanders, in total, 1.5 million tons of commercial residual waste is incinerated annually, of which today 25% is from us. We as Renewi are well positioned to help this transition because we already own the waste and we have the capabilities to develop and engineer these lines and invest the capital. We do think that smaller players won't be able, so we do expect a further consolidation of the industry. All in all, we believe this is a great opportunity right in line with our strategy. Increasing recycling rates, reducing resource depletion, and increasing carbon avoidance. Now, the investment case, we think, is very clear. We are building 3 lines of around 130,000 tons each in 3 geographical centers of Flanders, investing around 60 million. Now, our cost for sorting will go up, logically, because we do not really sort today these residual waste streams. But because this is forced by legislation, and we must comply, we can pass on the increased cost for sorting to our waste-producing customers. And as we take out more recyclates, a part of the increased cost for sorting can be absorbed by lower cost for our disposal to incineration. Now again, this results in an ROA of over 16% pre-tax in line with our group's requirements. And we anticipate that this Flanders legislation will also be adopted by other countries or regions. We are talking to the Walloon government as well as to the Dutch government to see how also in those areas residual waste should be and can be sorted and recyclates can be taken out. And we do expect even that it will go beyond our countries into other Northern European countries. All in all, a great opportunity for continued value creation for Renewi over time. A second clear investment case is our plastics expansion. This expansion continues. Plastics waste is among the biggest challenges society has because of its carbon footprint and because of its low recycling rate. And as Renewi, we have significant volumes from our collection, mainly of hard plastic and foils. We have been expanding our capacity of mechanical recycling of rigid plastics with the expansion in Ghent in Belgium and Waalwijk in the Netherlands. And now we're expanding our site in Acht in the south of the Netherlands as well, getting to a total of 100,000 tons of capacity. But also the quality of our recyclates will be increasing significantly. So we reach a purity level per polymer type, so polypropylene or polyethylene for instance, of around 98%, where today most recyclers are around 70%, so a step change improvement using latest technology. And this will allow us to replace virgin plastic in many applications with our secondary plastic, again, reducing the CO2 footprint for our customers. Now again, sorting more and better is also in line with our Mission 75, because we reduce the amount of lower grade, unsorted plastic going to incineration. A third program from our innovation pipeline is the bio-LNG. 2 years ago, we committed to build this new bio-LNG facility on our premises in Amsterdam, together with our partner Nordsol. Shell committed to buy the produced bio-LNG in a long-term contract, creating the security of outlets. A few weeks ago, I had the honor to open this facility with King Willem-Alexander, and now first production has started. This is the first bio-LNG facility in Northern Europe, underlining our leading position as innovator. And we're working with our partners to identify further opportunities for translation. Now, the final innovation project I update you on is our expansion at ATM in our minerals and water division. Toby alluded to the performance improvement at ATM already. At ATM, we are in a major transition. From cleaning water and soil, we have invested 17 million euros over the last years to further split the thermally treated soil into construction materials like sand, gravel, and filler. And the two main reasons we did that are, first, we created a new market with big demand for secondary materials, moving away from the traditional thermally treated soil market with challenging discussions around the quality of TGG to the construction market where sand and gravel are in wide demand. The markets we target are, for instance, the cement and the asphalt industry, who are very interested to reduce their CO2 footprint in building projects by using secondary materials. We also see an opportunity to add more value to the chain by upcycling heavily contaminated soil to clean and water and gravel and sell this at a positive price, where in the past TGG was placed in the market at a negative price. And by further increasing the quality and certification, we will further increase the market opportunities as well as pricing. We intend to return to the 1 million tons per annum of soil processed as we did in 2017. But where are we today? Now, to return to full production, 3 things need to happen that you see on the left side. First, we need to clean the decks, meaning that we have to move the old TGG that we still have in stock to create space and reduce storage cost. Now, as Toby already said, we're well underway. We already shipped 400,000 tons and we have commitments for another 250,000 tons in the second half, which basically reduces our total stock at the beginning of this year by half. And we continue to find new outlets, although they're more niche and there are many smaller ones that we see. It is more challenging than before. We also need to increase the pipeline of incoming new projects and specifically of contaminated soil. And we have seen an improvement over the last year as we increase our sales team and also restore our agent network to cover mainland Europe again, as we did 5 years ago. However, larger remediation projects are slow and are still hampered a bit by COVID, which is why it will take a bit more time to get APM back to full production. And third, we need to position ATM as construction material supplier. And this is progressing well, where new customers for sand, gravel, and filler are identified. We have signed contracts. And again, by increasing the quality and consistency of the output, we will obtain higher certification than we even have today, allowing a further increase. So I have full confidence in our journey to get ATM back and generate equal or more profit than in the top years. But unfortunately, it's taking a bit more time than anticipated. I would now like to move over from our innovation pipeline and ATM recovery to the third value driver that also should generate about 20 million of EBIT, which is our internal program called Renewi 2.0, Renewi of the Future. As you can recall, Renewi 2.0 is our program to harmonize, to simplify and digitize our company. And this year we continued to focus on delivering the benefits from this process improvement and workload reduction. A key milestone earlier this year was the launch of My Renewi, which is the portal we launched for our waste-producing customers to interact with us via an app or via computer. On the right side, you see how My Renewi puts the customer in the center and puts all processes from lead to order, to cash and to payment around the customer. These processes are now digitized and customers can interact with us 24/7. And today we have more than 40,000 customers that have gone into the platform, and we continue to increase our adoption rate every week. Also, with our suppliers, we interact now through a procurement to pay platform. We went live in Belgium, and we plan to go live later this calendar year in the Netherlands, followed by the UK. With Renewi 2.0, we are on track to deliver our committed benefits. More satisfied customers and employees, and a minimum of 20 million run rate savings by the end of fiscal year 23. Now, this brings me to the end of the presentation, so let's wrap up. We finished a strong first half and increased our outlook for the whole year, supported by strong tailwinds. Over the medium term, we are committed to deliver the 60 million euro of increased value with our 3 value drivers I talked about. And for the long term, we see more and more evidence that the transition to a circular economy is happening, with a climate emergency that requires to act now. With increased legislation against incineration and CO2 emissions, and more drive to stimulate the reuse of materials, with consumer good manufacturers stepping up to the plate, and with innovation allowing recycling of waste in more advanced ways. We are convinced that this will result in an increasing demand for secondary materials at a higher quality. We at Renewi, we are extremely well positioned to be at the forefront of this transition and benefit from being a leading waste-to-product company. Thank you,